Oh, hello everyone. Welcome back. Our weekly get together to talk about trend following. It's been a good week, interesting week with the Fed and with the markets and the stock market. Hopefully these trends will continue and we all eventually have on the right positions. I frequently don't have on the right positions, but it takes me a little bit to turn this big battleship around sometime. I listened to some really great podcasts this week. I want to talk about those. The Yesterday with Meb, I tweeted a lot about that one. That was some good stuff. If you haven't read those, go read those. And it's about return stacking, which is just putting a lot of markets together using leverage and adding trend following to the stocks and bonds. Those are really smart guys who put that together. Corey and Rod, I think is his name, and they're really good at coming up with new names as well. So that was interesting. And then Eric, who has a fund, CTA fund, trend following fund, that has half the positions long all the time in the stock ETFs. So that was interesting too. I had a lot of differences with that idea, of course. That's interesting to chat about if you're interested. And then, I learned a lot of this week about pyramiding. I was talking to Richard and Moritz, and we were discussing pyramiding. And I think, I kind of knew what pyramiding was. I've said what I thought it was, and I wasn't too far off. However, I really didn't put a lot of thought into it, and then it does seem to be something very different than trading multiple systems, for instance, that have their rules. And so I think that's a pretty interesting concept. And some people, it seems, use pyramiding, and they have pretty good success with it. And then I had a friend back in the day who used pyramiding, I think. Although he talked bad about pyramiding, now that I think about it, one of his strategy might have been a lot of pyramiding. So, but that's a very interesting topic as well. Okay, good morning, Oleg. Are you ready to take?
Yes, good morning, Jerry. Good morning, Richard, Brian, Bruno, all the guys. Alip, of course, Seth, and all the guys I see here. And I always say that I'm very happy to see you. I'm very happy to take part in these conversations. It's one of the most important things for me. So, it's very hot summer in my place. I had a nice swim in the sea yesterday. So, and now I'm near the sea and nice forest. So I have listened a podcast with Jerry and Mike Melisinas, because before I had a problem with program issues with all this, and maybe yesterday I registered there with VPN, and now it works okay. And it was really very interesting, like all the discussions where Jerry take part. It's very interesting for me to listen, to take notes, and I did notes today and yesterday. Had published my notes from episode number 7. Now I'm listening episode number 6. So it's very great to have an opportunity to hear such wisdom, knowledge, and to take notes. So let's get started, and I'm very hopeful that there won't be a lot of program issues for me today in this trend following trading ideologies weekly gathering. I hope all will be okay. So let's get started. I'm very happy.
Hi, Oleg. G'day, Jerry. How are you? Look, you might be getting warm, Oleg, but I'm getting cold here in Queensland, Australia. It's always referred to as sunny Queensland, but it's getting a bit chilly during the winter zone. Jerry, I did listen to the Meb Faber podcast with Corey. That was a great one. I didn't listen to the Eric one. Is that Eric Crittenden?
That's right, Eric from Standpoint.
No problem. Look, I didn't manage to listen to that, and I also have got to catch up on your latest with Mike. I've been pretty busy this week, but yeah, look, I love that conversation that you and I had and Moritz had regarding Mulvaney and the pyramiding. What I was really surprised with was how Moritz, with the information that he had at hand about Mulvaney, was able to generate a back test using the 45 markets that Mulvaney trades, and even without pyramiding, he was able to pull a result that was seemed very similar to me to Mulvaney, which tends to suggest to me I'm just wondering whether there is extra juice from this pyramiding or not, because certainly the returns on their own, when I think Moritz was using a 200 period look back for a Donchian breakout, and he was using a 3 ATR stop. It produced a win rate of around about 28%, but it produced amazing risk to return levels, and certainly the annual returns he was getting seemed to be very similar to what Mulvaney was pulling. So yeah, I just wonder how much benefit Mulvaney gets from pyramiding. He did mention, or it was suggested in his institutional presentation, that he used pyramiding, and the reason we thought that was that his expression was that as upon entry into a trade, he progressively increases positions on that trade as the trend developed. And I was thinking immediately in terms of pyramiding as opposed to what you and I do, which is, these ensemble systems, which are all uniquely configured. This pyramiding process works on the principle that you use the same trading system, and as your trailing stop progressively gets you into more profit, where you then supposedly have a free trade based on the fact that your trailing stop is paid for the last trade you've taken, it allows you to put another position down on that same system using the same method, and progressively as the trend evolves, you get more and more concentrated and committed to that trend. But, as we discussed, there are many sort of ups and downs, of that compared to what we do. And perhaps in this discussion today, we can get into some of the differences between the ensemble approach, the pyramiding approach. Would be an interesting discussion.
Right. I'll try to explain what I think is the difference. And so what we do, I think, is we have a risk budget where we want to risk like 1% per trade, just to keep the math simple or simpler. So we want to risk 1% per trade. So if a trade gets going, if sugar gets going in a big uptrend, or cocoa, we're going to basically put that trade on with a fixed risk that, for instance, if we put that entire position on, we would lose 1% if it hit. That's how I look at it. If it goes against me by my ATRs, my stop loss, my small loss, it'll be 1%. So I'm going to split that up with 4 systems into 0.25% each. And it's defined, and the systems have different entries. They will get in sometimes as the market goes up, the next signal will be hit. And so, but I'm done after 4. It's predetermined risk and predetermined number of entries. And it's back tested, and I'm very consistent, and I apply these systems. Sometimes only 1 or 2 get in, they turn into losses. Sometimes they all 4 get in. Okay, now with this pyramiding, it's almost, I'm a little unsure. Maybe it's a little bit of undefined maximum position. Hey, look, if the market keeps going up, I'm going to keep buying. And I've seen this happen before with tremendous success. And as I said earlier, but also the person who was doing this was telling me, I don't really believe in pyramiding, but he did say that, well, I just keep buying. I mean, I'll just keep buying all the way, like still buying in cocoa and sugar, maybe. And so, so towards the end, those trades get to be not so good, but he just keeps buying in case there's some sort of crazy outlier that's 500 ATRs. Okay, so now it doesn't seem to me to be as systematic and as repeatable. Sometimes I put on X position and because the market goes up a bit, and sometimes I put on 10X because it just kept going and going. So that doesn't seem to me to be something that's very interesting to me because it's not back testable. And then where's your sample size when you start buying these things? You only have a few trades where they just keep going and going, and yet you're still buying and buying. So I don't really understand that sort of idea so much. And then another thing too, I don't understand is the trader in particular we're talking about. He has a tendency to let profits run and have very, very loose pants. So as you're buying, you're not sort of financing that next piece with locked in profit. Oh no, because it all can turn into losses because he has loose pants. Oh, I guess, yeah, well, I guess he would take a small loss. Yeah, that's right. He could take a small loss on some of those pieces, but they're not locked in on the profit side. I guess it wouldn't get too much out of control if you started losing on your last 10 buys. But I don't really think he can lock in that profit because he has the loose pants. He's going to try to hold on to those trades as long as he can. And but it's a very unique approach and a very low win percentage, in the 20s or 20. So very interesting. What do you think, Richard? Did I make a mistake?
No, I think you were spot on. And something I didn't mention was that Moritz used a 3 ATR on the initial stop, but then he allowed, I think, for a 15 ATR trailing stop to mimic Mulvaney's approach. And that is incredibly loose pants on that trailing stop. And you're totally right. If he was pyramiding, it's not necessarily pyramiding after your prior trade has reached break even or above. So yeah, no, I totally agree with you. And what I like about an ensemble approach that you and I do, Jerry, is that, as you say, it's all about trade sample size, because each of our systems has a significant sample, and each of them are traded individually and treated as separate systems. And you can rigorously, in those buckets, look at the sample size, but under a pyramid approach, you can't. Because it's dependent on perhaps a few significant trades in the course of your history, and that's hardly a sample size. Another reason I really like our ensemble approach is that it forces us to have diversification of entry. It forces us to have diversification of exit. Whereas a pyramid, once you get into one of those pyramids where you're increasing your position size using the same system, you find that system defines the trend in a particular way. And when that trend is over, all of your positions exit at the same time. So you get this massive correlation effect on exit with pyramids. So that's one of the specific reasons I didn't employ pyramiding with my processes. I think the method that we deploy, treating each system as unique, enables us to capture different aspects of a trend, because there can be many types of forms of trend. It's not specific. Our multiple systems are each defining trends slightly differently, allowing them to capture different aspects of that trend, and they're certainly far less correlated than, say, a pyramid approach is.
Well, I have done research in this area, and the problem, the one of the issues with breakouts. I don't want to get too crazy because breakouts obviously don't have any problems, right? But the one of the issues with breakouts is that they can bunch up, and system 1, 2, 3, and 4, even though they're spaced out in the look back, they can all be elected at the same time. And I have a feeling that that's a better trade if they're all elected at the same time. In my opinion, that's a better trade. There's nothing you can do about it. You have to trade each individual system by itself. But we don't get it's a bummer. We have these 4 systems. We'd like to have 4 different places to enter, and then hopefully we have 4 different places to exit. But I think the give back on that is that if they all bunch up together, it's probably a better trade. Okay, it's my opinion. But okay, so we did some research on this, and we said we don't like that bunching up together. So what we did is we forced the four systems to not bunch up. So we had one breakout, and then system one got in there, and then system two got in an ATR above there, and system three, two ATRs above, and system three, four, three ATRs above. So it was forcing this spacing, kind of like pyramiding in a way, and using the ATR, but anchoring the initial breakout and forcing this spacing. So what we found was that unlike the four different breakout entries, these four different spacing systems spaced out by ATR, they stopped working at some point, like 5, 6, 7 ATRs above the fixed breakout. It was not, you saw a deterioration, and there really is no deterioration if you use the 4, 5, 6, 7 breakout signals. So I'm very skeptical of this ATR approach. I'm skeptical of using ATR in any way other than sizing the initial position. I've said that before. I just think it's not see issues with it in the research. Okay, so I do think it's fair though to call those four systems that enter by spacing each other out one ATR higher than the last system. I do think that it's fair to call that four different systems. So I do think it is systems. I think it's fair to call it systems. I just don't think it works as well. And this is that on steroids. This pyramiding is kind of that on steroids. There's no necessarily predefined stop point. You know, we stopped after four, right? Four different entries. We just keep going. And in the research, even if you do the research based on what we did, after 4, 5, 6 ATRs past an initial breakout, the performance drops off materially. And I don't know if that's because it's too long term of a breakout on the entry, or there's more of a magic when you use the computer likes the consistency of the breakout entry more than it does spacing these things out based upon ATR. I'm not really sure about that, but I just knew what the results were, and so I stopped doing it. As much as I wanted to space things out, I thought it was incredibly important, and sometimes it is, but I think overall it's better to just suck it up and trade the better approach and just realize sometimes you're going to get bunched. I mean, I remember in 2012, we were buying, we're selling heating oil, crude, unleaded, like all four systems, like all on the same day sometimes. We're just getting our asses crushed and whipsawed to death on that. And we underperformed like crazy. And I thought, oh man, we've got to stop this. And we did our best to try to force things to be spread out. And I think forcing the system to do something that you really think is beneficial, you should not, whenever we tried to do that, we just saw worse overall results. It's like you can force it, you can have this itch scratched, but I cannot let you make the same amount of money.
Hi guys. Hey Jerry. Hey Richard. Hey guys. That's a very interesting conversation actually. Now, I have coded this sort of pyramiding up. So it's definitely a quantifiable method. So if you take a step back, how are you going to pyramid up on an outlier, right? How are you going to harvest an outlier by pyramiding it up? Either you're going to use, like ATR spacing, like I have coded it, like every, X ATR, you're going to increase the positions, or you're going to use multiple systems and trade the same market. So that, either you're going to use, let's say, a Donchian model and the moving average on the same outlier, on the same sugar trade. So you're going to open up two trades while the sugar is moving on. So this is basically, more or less goes to what Richard and Jerry is doing. Or you're gonna take a step back and say that, all right, if there is a massive outlier, I'm going to pile on it by opening up new trades. And I want to be trading this in such a way that, if I'm going to use 6 ATRs in my own trading, then I am going to enter a new trade every 6 ATRs. So basically, I'm going to keep my risk small, right? So basically, I'm going to keep my risk small, and I can just, basically prem it up to the moon, that sort of an approach. So that's, and one of the benefits of, increasing the position size every 6 ATRs or whatever the ATR that you wanted to test is basically you're going to keep the risk small. And, if it is a highly volatile instrument, your leverage is not is never going to be too much. And if you think that you're uncomfortable with that leverage, you go and buy yourself a put option. So you really don't have any leverage issues, but you're just piling it on forever, sort of an approach. So so that's one way of doing it. So this is not how we are talking about here. So that's why when I was speaking with Richard earlier on, I told him that he is also definitely premiting it up, but he's premiting up with the loose pen. So there are two ways to prem it up. Either you use one stop as you open up your trade every 6 ATR, you keep the risk. Even though you have two risk units, because you bump up the ATR up, so at that moment your risk is smaller, okay? Or you're gonna do it the way that the Jerry and Richard is doing. So really, there are two ways to do that, and I mean, is there a right way? I don't think there is a right way, really, and that's the most important part. When people speaking up about Paul Mulvaney, but when I see it more of someone else who's able to self-express himself with the system that he has designed for his psychological needs and the way he wanted to self-express himself. Okay. So I think the key is, while you're doing this risk management right, okay, you're going to keep the risk management right, and then you're going to understand who you are at a very deep level. So while you're trading, you're going to either prem it up one way or the other way, and there is no right way. There's only a right way for you. There is not a right way for everyone else. When Richard is premiting up using 10 systems with many multiples of different entry methods, entry method A, entry method B, entry method C, someone else like myself might just use perhaps to choose to premit up like Mulvaney. But I'm not doing that, but it's just depending on who you are and how you would like to do your work. It's a very individual sort of work, really, and it would be, I would say, very very much immature to judge someone else's work with your own eyes, because your beliefs about life and how things work and how you would like to self-express your emotions and your beliefs and your life with the work that you're doing is different, and eventually you're gonna prem it up different, if that makes sense. Thanks a lot.
I notice Moritz is here, Jerry, and I probably stole his thunder talking about what we discussed with Mulvaney, but I'd love Moritz to come into the conversation and tell us about the research he undertook with Mulvaney and some of the findings, if he wants to discuss them.
He's definitely been invited, so we'll see. He may be running more research, so don't want to discourage him from doing that. No, but I think the key here is, in my opinion, is that you need to be consistent and apply these rules in a consistent way, and that trumps everything. And if I think that pyramiding would be a good idea, let's say for me, I could see doing it, but only if I had a predetermined number of pyramids. So I'll do it 10 times, And I don't think it's practical, nor do I think it is what people do. For me, it wouldn't be, I don't think this would work out well on the back test. I think what Alp was saying, something like, okay, if my stop loss is 6 ATRs, then I'll add every 6 ATR in profit. I don't think that's what they do, and I don't think that that's practical because I don't think it works very well. They're adding much more frequently than that. I do think it's kind of this amazingly great internal money management type scheme that I'm not offended by, like I am about most money management, vol correlation, dynamic position size overlays on top of trend following. I don't like those, of course, because they really screw with the sample size and it's watering down, and it's just a mess. That's just a mess. And so I do, but I do think that predetermined number of entries. Now, one of the fun things about this is I ran this test as well, and I've mentioned this before, but to keep the numbers kind of simple, let's say when you put a trade on at the breakout, and the expectation of the trade, the average win is, let's say, 3 ATRs. So, okay, so you've done this big back test, you got thousands of trades to look at, and every time you do a trade in system one, the computer says, well, you're going to make, on average, 3 ATRs. Entry, exit, 3 ATRs. Okay, now if that initial trade at some point during the trade has 3 ATR profit in it, so it's made 3 ATRs, the expectation of that trade, that group of trades, is now 6 ATRs. Okay, so what's great about that, and then of course, if you have 4, the expectation is now 7 ATRs. So it's a pretty easy test to run. Of course, the sample size is diminishing all the time, but it's basically saying the built-in profit, ATR for ATR increases when you have this built-in profit, this expectation of this particular trade. Doesn't mean that trade's not going to turn into a loss. It just means if you look at all the trades that have a 3 ATR profit, the expectation on those trades is now 6 ATRs, that group. Okay, so what's great about that is you're minimizing the thing all of us don't want, which is stringing together a lot of losses. It can happen, but now the odds are so overwhelmingly in your favor that you're not going to take a loss on the previous trade because now with this built-in profit, which is fantastic, classic trend following plus nothing money management, sort of money management. You're really going a long ways to helping minimize the capital losses. Okay, so it's great. It's fantastic. But in my research, if you force that and you're forcing these ATR profits and spreading these trades out to some degree, the trades get worse as the trend develops versus just using breakouts. So that's why I became such a huge fan of that idea because I understood that analysis, but it doesn't work as well as just paying attention to the breakouts because sometimes all the breakouts happen at the same time. However, I do think that there's evidence that is a superior trade. Yeah, that's enough. What do you think, Rich?
Yeah, look, I did like what Alp said, but I do slightly disagree with him because I suppose that the way I approach trading these outliers, I've got to be consistent in what I say about these things. So as you all know, what I say is that these outliers are these unpredictable anomalies. They cannot be defined statistically by quantitative methods. They're a hindsight phenomenon, and they take many different possible forms. So if I say that on one hand, and I'm also an ardent proponent of not dynamically position sizing, not volatility adjusting because of the chaotic properties of these outliers. I can't then say, on the other hand, that I would pyramid into a trade. In other words, under the same system, I would progressively concentrate my risk in that trade because the trend was developing well. Because that to me is a sort of a predictive assessment, saying, the quality of the trend is improving, therefore I can increase my position sizing on this trend to hit the ball out of the park. So I've got to be consistent in what I say. And so therefore, with this ensemble approach, what I'm saying is that this chaotic form of outliers demands that we trade very small bets, but we diversify those bets extensively because we don't know what that future trajectory of that trend is going to be. And in that capacity, I therefore treat my ensemble as separate systems as opposed to a pyramiding approach. Each one is configured differently. And if you map out the nature of those systems, you'll see that they're diversifying across time and space. Some of the systems have shorter term lookbacks, some of the medium term lookbacks, some have longer term lookbacks. They're diversifying in a whole array of different perspectives simply because the statement I'm suggesting with my method is that I can't predict what these things are going to do, but I do know that as my systems progressively get engaged with this outlier, it is a natural consequence that if that outlier is an enduring phenomenon, then it is high probability that I'll have all systems engaged at certain points during that outlier. That's a different statement to concentrating my risk on a specific bet. In other words, risking more and more capital. It's effectively the same to me as these methods that Rob Carver suggests, continuous signalling. As opposed to discrete signals or binary signals that we use in our approach. This continuous signal is based on an assessment of the trend strength, thereby if your assessment of that trend strength is it's a high quality trend, you should invest more in that trend. So if I adopted that principle, I'd find very quickly that my portfolio got overweight with specific signals or particular trends, and I'd find that the risk in my portfolio would increase because certain return streams were highly concentrated, others were less concentrated, and it sort of mucks up the whole principle of having equal weighted bets across my portfolio. It's sort of mitigating risk of all return streams in my portfolio by concentrating risk in a particular return stream.
I got to the discussion a bit late here. I was busy with other stuff, so I may be repeating anything that you guys said, but I'll just like to share my experience with these pyramiding systems, and I'll be glad to hear what you guys think about it. The first systems I tested and implemented had some sort of pyramiding within them. It was a breakout. They were breakout systems, pretty much like Curtis Fate describes in his book, and where I have a breakout signal to get in, and from that breakout, I look at some ATRs from that breakout to increase my position. And the problem I found with that system was that the hit rate was pretty low. Because my ATR stop had to be somewhat tight. I was trying to increase the look-back period from what Curtis Fate has in his book, that is 20 in, 10 out, and 50 in, 20 out, something like that, from system to system 1 and system 2. And so I was hearing Jerry and Niels and Moritz discussions on Top Traders at the time, and I remember Jerry saying that he increased his look-back periods over time. So that was what I was trying to figure out. But the ATR stop on that system was 2 ATR. So for a 75-day or 100-day or even larger than that look-back periods, 2 ATR stop is too tight. I was getting out of the trades too soon, and that's why I had this low hit rate I was I was trying to find. So, but that's okay. The other problem was that the risk was getting too out of hand when I implemented the systems, because I had to have small positions that was they were small at the beginning, but as the trade progressed and I was pyramiding it, my position was get too large and the risk was getting too out of hand. So the trades were they were stopped a couple of days after the second, third, and or fourth levers were activated, the pyramiding stuff. So I didn't have much of a good experience with them. I couldn't get my hand on it, to be honest. And then I defaulted. I came back to the drawing board, and then I started studying and finally implemented the systems I'm running right now that has no pyramiding stuff. It's pretty much what Jerry and Richard describe of their systems. That's just one entry, one stop, and one exit. I think these are much better to understand. The sample size on the pyramiding stuff is pretty strange to understand, because you don't know exactly how to compare the trades. When you have only one entry, one exit, and one stop, everything is pretty comparable. They have all the same risk. They have all the same expectation. It's easy to understand what's going on. When you have a pyramiding system, how do you compare the trades that were not pyramided in, the trades that had a second lever activated, the trades that had the third, the fourth? It's strange. I understand the motivation. I understand that you have you wish to have somewhat convexity within the trade, that you're increasing the position as the trend goes in your favor. But from a risk management point of view, I don't quite understand what's going on. And from the back test point of view, I had a hard time comparing stuff. So sorry, that was a pretty long rant. I would love to hear what you guys have to say about it.
Yeah, you look. I have coded this thing. All right, and it's not a baby code. It's a very serious amount of number of codes, and I'm able to do this with minute bars. You know, so my observation is it just works if you're going to be consistent about that. Everything works if you're going to be consistent and disciplined about it. Who cares about winning 20% of the times or 25% of the times or 30% of the times? If this is how you want to express your work, okay? So, the risk is, the 6 ATR is just an example. It doesn't matter if it is 6 ATRs, 2 ATRs. So you're going to design a system with the sample size. And once you code it, it is possible to code it. I did, so other people can definitely do it. Backtest works, risk management works, and it is the same outlier, okay? It's the same sugar trade. So it's really not different than what, Jerry and Richard doing. They are using different systems with different exits, okay? Their entries are also different. So the only thing that this sort of pyramiding does is, the only difference is, okay, everything is rule-based, everything else is programmable. So what is the difference? Well, there's only one difference. It is either you're going to use different exits, which I call loose pants pyramiding, or you're going to pyramid up tight pants and you're going to use the same stop. Okay, so really, it doesn't matter whether you're scaling in every X ATRs, or it doesn't matter whether you're scaling in using a moving average versus a breakout versus a Bollinger Band or a Kettner channel. It doesn't matter really. So the whole idea is to be able to harvest an outlier and risk manage, okay? And then run that system on a consistent basis. and then love what you do. You're gonna love the work that you're doing it, right? You're doing it because you love it. It's your, it's your self-expression. That's your beliefs, and that's some people, you know, is happy with 2 ATRs, and some people is happy with 7 ATRs, and you know, because these people, some people would like to have, you know, one people say it is choppy, low hit rate, and other people says, okay, this is who I am, and that's I'm happy because I'm self-expressing myself and my work like that. So there is really, these are all systems, and it's possible to come up with a positive edge. As I said, there's only one difference really: how you're managing your exits. Are you managing your exits like Richard and Jerry is doing and using a different exits, or are you actually making a money management scheme and increasing those trailing stops to the same level, so you're exiting at the same time? So other than this, everything else is the same. Is scientific, is outlier basis, is pure trend following, is trend following plus nothing. But the money management is, I would say, loose pants versus tight pants pyramiding up. And when Jerry Parker says, I wouldn't use it, of course he wouldn't use it. Because he's self-expressing himself in his business, and in a way that he has evolved in 40% win rate, right, giving a lot of room to the trade. So this is a very particular belief about how things work. Who am I? How am I doing my work versus, having 25% win rate, and going a lot of trouble actually, and it just doesn't look good. It doesn't feel good for many people, right? It's just not intuitive. But many of the things that we do is not intuitive anyhow. There are many things that we are going against our nature while trading, like cutting our losses short and letting our profits run. I mean, it's endless, the number of things that we are going against our nature. So what we are discussing here is how many properties we're gonna add to be able to go against that nature more. That's all. And there is some easy. Some people would see one approach easy, the other people would see the other approach easy. But everything else is, to Richard's comments a moment ago and what Bruno said, mainly, is everything else works the same sample size, the same outlier. You go for the sugar trade, you scale it up. Either you scale it up on one Bollinger Band plus a moving average plus a breakout plus a Keltner band plus something else, or you actually go ahead and do it like Richard is doing, and or just use it with the ATR scaling up, right? I'm going to scale up every X ATR, every 6 ATRs, I'm going to increase it and put my position. Is the key is to be able to manage the risk. You're going to manage the risk, you're going to manage the leverage, which is possible, okay? And then everything else works. The issue is, the core of the issue is being consistent and to be able to do it over a very long term. And this can only happen if you're able to reflect who you are with the work that you're doing. Otherwise, I don't think that you can be successful. And many people who are actually are not succeeding is trying to take someone else's work and without looking themselves are trying to implement that, and that's why they are actually failing, because in my opinion, what my belief is that actually. Thanks a lot, guys. Cheers.
I agree with you, Alp, and most of it, mostly, I mean, and I'll just say that I don't quite agree with this statement about beliefs. I think what differs us systematic from the discretionary side is that we are much more of an empiricist. We have much more of an empiricist heart at our core. We're far from the conviction of a discretionary trader, where when he
Bruno,
says that
everything I said is systematic. Yeah, I didn't mention anything
I know,
discretionary, brother.
I know. I'm just saying that I'm not I don't agree when you say that we believe in our systems. I think we test them. I think we build our trust in them from the back test and from the real trading. I'm just saying that I don't agree with the statement about beliefs. And on that spirit, I would like to ask you, how do you measure that success from the pyramiding systems? What statistics are you looking? And look, I'm honestly asking from a out of curiosity, out of the intention to learn here.
I mean, look, as we discussed, what is the difference between loose pants pyramiding up versus tight pants pyramiding up? How you're managing the exits. Other than that, there is, in principle, what is the property of a pyramiding up? The first property is you're gonna answer multiple times on the same outlier, which Jerry and Richard are doing. They're answering on the same outlier multiple times. So they are using different systems, different entry methods to be able to do that. And the tight pants pyramiding up trader might use different ATRs, like 2 ATRs or 6 ATR or whatever you're going to test it. But the idea is, the property is to be able to answer multiple times on the same outlier. So that's number one property. The second property is, if we just model the pyramiding up, okay, as an idea. The second thing is, you're going to risk manage, okay? So you're going to risk manage it. So if you're pyramiding up every 6 ATRs, and if you're using 6 ATRs for your stops, of course, what happens is, you can take more risk, right? So that's the main thing about using equal ATRs. But because I have coded this thing, I can use whatever ATR I want, right? So you're talking about this tight pant pyramiding up. So I can use 2 ATRs, 3 ATRs, 10 ATRs. It doesn't matter. And I manage the risk. So you're gonna manage. So this is the second property. So if we just dissect this concept, this idea into its properties, the first is multiple entries. The second is the risk management. And the third thing is, you're going to have either multiple exits, which means that you are actually pyramiding down on the way down as well, right? So while exiting, so what Jerry and what Richard is doing is, they are pyramiding down as well, because their exits are different. Or you're going to use one exit to exit the pyramid up. All right. So these are the properties. Okay. And as long as you're doing 2 out of 3 of those things, you're pyramiding up and you're pyramiding down. So what is the difference? Well, risk management is the difference, but you're back testing it. Everything else is coded, right? Everything else is coded. So there is no discretion whatsoever. There is no discretion. Everything else fully diversified. And you can do what Richard is doing. You can run 10 systems and you can, pyramid up and down on those 10 systems if you wanted to. It just, when you say the beliefs, Bruno, is your beliefs is because with these systems, with so much flexibility, everything else that we do is about our beliefs. I'm trading minute bars, right? And riding trends, and a long-term trend trader is trading, daily bars. Jerry Parker is using 4 systems, but Richard is using 10 systems. So everything else that we do is all about beliefs. So that's the work that we are doing, and that's the critical part. So if you do this because you've seen it is most profitable, and that's why you're going at it, I think that's the trouble happens, because you need to be consistent, and you should be able to do it in many years, and then you're fine with it. Thanks.
I'm sorry, Alp. I didn't meant to call you a discretionary. But yeah, That'll be a heresy in this space. I'm just kidding with you, honestly. Yeah, I think I learned something new here. You said that you're pyramiding down as well. Perhaps that's where I ran into difficulties when I tried to implement this. I I got in. I increased my position as the trend went in my favor, but I get out everything at the same time. So perhaps that's where my frustration came from. I mean, the bad results came from, and that's where I think the risk was getting too out of hand, and the give backs were too steep, much steeper than a simpler system with one exit and one entry and one stop. But yeah, that's
And
where
also,
I lost
look,
my train of thought.
you're gonna
Thank you.
use this. If you want to prem it up, you're gonna prem it up on the things that are going up and going up well, like single name equities. Okay. Now, single name equities are going up since the last week of May. I mean, if you wanted to prem it up on a market like this, well, it would have possibly worked much better than premiting up on a sugar trade. So the trend qualities needs to be very good as well. And premiting up and down is a very common approach in the equity market, in the single name equity market, because it trends on the bull markets. Bull markets are all about trending. So you're gonna apply this thing to a market that trends well. And in the past, when people were doing this, they were also, so this is one thing. You're gonna so we dissect this thing into properties, and one property is, of course, you're gonna find you're gonna do this in all of your systems, in all of your markets, but those markets are better off if they have markets with the tendency to with a high trend quality. So signal to noise ratio is important, and in these days single name equities are really good places to look into it. And of course, I don't trade like that. But as an idea, so when you're saying it is very much choppy, yes, it is going to be. You're not going to get 40%. You're going to get 25%. I mean, your drawdowns are going to be higher, but I'm using hourly bars, so my drawdowns are not that much anyhow. If I wanted to do that anyhow, so so you're using daily bars, I'm using hourly bars, so that I do have an advantage there if I wanted to apply it anyhow. And then, so there are many alternatives in the work and the way we self-express ourselves, in the way we work, right? You can go into many other dimensions. And does premiting with the tight pants work? Yes. Is it scientific? Yes. Is it trend following plus nothing? Yes. All the boxes are ticked, but it's just a little bit obnoxious, and you need to be a quite your psychology needs to be quite different. I mean, as I mentioned, we are already doing so many unnatural things when it comes to trading. So with the tight pants premiting up, there are more properties to add that unnaturalness. And one of those things is, of course, the low hit rate, because you're increasing your stops with the tight pants. So what happens is your hit rate is lower. So you should be able to live with that. And if you're able to be consistent, it works. So really, who would do these things? I don't think a fund manager would do these things. That's why I wouldn't see Richard is, for instance, doing anything else of that sort. Okay. So this is more of a, people who would want to do, what is the main benefit? I mean, if you're increasing it every 6 ATR, so your risk stays the same. It's beautiful. So if you wanted to take more risk and increase your position size as a money management gimmick, there you have it. And it's all testable. Oh, what? Well, it's 25% instead of 40%. So be it, but it's a choice, guys. Thanks a lot.
I think it's interesting that, probably a little bit of clarification needed for this loose pants, because on one hand, I think this example we're using is that they have very loose pants, but the trade has to be a profitable trade, and it is very tight pants if the trade is a loss. So that's not something we've really talked about, but yeah, I'm kind of agreeing with Bruno in that I don't really want to express myself. I don't want my too much of. I mean, it creeps in. I think this stuff kind of creeps in to everybody's research and systems, but I don't really want to. And just because I don't want it doesn't mean it doesn't happen. But I would prefer my not to have an expression of what I would like my trading to look like. Because I already said, when I go in there and I feel like, okay, I really disliked some of the characteristics of my trading with these breakouts, so I'm going to force these entries to space themselves apart. And I really like that. This is what I want to express. Well, I do the research and it says, well, it's not as good. Oh, well, then I don't like that. So I wanted to express something, but I limited myself because the research said no. Now, I think, as I've already said, you can open yourself up to other people saying, well, wait a second, I think that you have violated that idea in the way you've described other ways that you trade. And my response would be, you're probably right. I think that we want to get in there and root that stuff out to where we're doing something that and we kid ourselves. It's two. The choices are the same. I can do it this way, or I can do it the other way, and then I will. I'll just choose the one that makes me happier, and I think that that's probably not true. And we've already stipulated that what makes us happier is making more money, and what makes more money are doing things that make us unhappy.
Hey, everybody. I was just curious for those that have tested pyramiding, does it add return without adding additional risk or drawdown or volatility? Or is it just, in effect, adding more leverage to the system?
Oh, it adds big time leverage, but you're gonna, it adds big time leverage, but depends on the product. So if it will add a lot of leverage on low volatility markets like bonds and forex, which you may need to use a put option to protect yourself for an adverse activity. Okay, so a downside protection with the put option will be needed. But if you're a volatile instrument like crypto or single name stocks, no, it's not going to. It's not going to be as much leverage. So, but the system is so versatile. It depends how you implement it. So I'm talking about a system where you can scale in every 6 ATRs, where your stop loss is 6 ATRs. Okay, so this means if your risk budget is overall for your systems, if your risk budget is 10%, okay, then you can risk another 10%. So immediately you will have the option to have a 20% risk budget with using actually a 10% risk budget, because you're increasing your stop losses every 6 ATRs. It's beautiful. It's beautiful. Why? Why it's a problem? Well, it might be a problem for the long-term traders because the systems, inherent systems, are already very volatile. The drawdowns are too large. So that's number one. So you're gonna be happy with the drawdowns. It's going to be more drawdowns for sure with the systems, with the long-term systems. But if just 10%, but actually take the benefit of having a 20% risk budget, yeah, you can do it. That would be the benefit out of it. Thanks.
I think we all understand how you're implementing this and explaining it. But I think what Bruno asked you earlier, and what I'm kind of wondering is how much additional return are you getting out of adding pyramiding without increasing the risk? So on a risk adjusted basis, are you adding return?
Oh yes, it is adding up because you are actually if in the hypothetical case where you are increasing your risk budget, let's say if you're trading with a risk budget of 10%, your initial stop loss is 6 ATRs, and you are scaling up every 6 ATRs. So this means that you will have the option to scale up and to use a risk budget of 20%. So your returns are going to be, in my tests, are definitely, it's just the volatility and the hit rate that becomes burdensome. Am I using it? No, I am not using it, because what is the exact opposite of pyramiding up? So pyramiding up has been used in the past because when the turtles were trading the 1970s, their height was trading. There were not many markets available then. Okay, so it did make sense, and that's why so the exact opposite of coming to the same conclusion with a better drawdown profile, with a much better hit rate, is to be able to use a huge number of markets. Okay, because today we have the advantage of using huge number of markets. Cole Wilcox has sent a tweet this week saying that you don't have to trade the entire index for single name equities. You just need to trade everything else, and then just stop out the ones that stop out, so that you're riding the outliers. So this is your new sort of pyramiding up today. So this is how we trade today, to be able to have the same leverage, the same sort of risk budget. We want many markets. So that's why I don't use it. It's a technique. It's best needed to stay in the past, where the number of available markets are not too many, and you wanted to make more money than 25% CAGR, which is quite a good CAGR for a long-term trend system. And if you wanted to approach the 40%, then then here you go. Just go ahead and do a pyramiding up. It works. But what Cole has sent, and which I have retweeted, is a better approach. Which Jerry Parker is saying, which Richard is saying, is a better approach. Let's trade very small, but as many markets as possible. That's when you trade 500 markets, that's your pyramiding up, without going through the hassle of 25% 25% hit rate and a very high maximum drawdown. So that's what my research is saying. Thanks a lot.
I think that if you're trading this sort of pyramiding idea, or just continuing to add, because I think the pyramiding, in my mind, if somewhere I heard that it has something to do with, I can afford to do the next trade because I have profit in the previous trade. So given that, I'm going to do the next trade. I can afford to do it. My money management says that. I think, as I said earlier, the expectation on the previous trade has increased a bit by this profit that it has, but by no means does it ensure that it's going to be profitable. And I'm a little dubious as to whether it says it's a good money management to assume that you can take on more risk because of another small open trade profit. That's not how we do it. I lost my train of thought, but I do think you would trade incredibly small. I think this does allow you to trade very small. So if you have 50 to 100 markets, you're almost trading as small as I am with 300 markets with my predefined 4 systems. Each one of them use 25% of the risk budget. But this is a great way to trade. And you really start hitting some home runs and it's almost like you're this pure trend follower. And I think you could sort of say to yourself, yeah, I haven't done the research, or I'm not going to do the research, or the research doesn't look that great as compared to the way someone else might trade 4 systems, but I've got these 40, 50 kind of systems, and I'm just continuing to add, and I'm just being this diehard trend follower, and which you can't predict. Sometimes you could see these big trends go on forever, and I'm just always adding, and I'm going to hit some big, huge home runs. But they are trading very small. I don't think that they're trading large. Well, I mean, relatively speaking, because Mulvaney does trade very large, but I think if he would trade large if he had my 4 systems, he would have probably the same leverage or something close to it. Because I don't think this type of trading really does a lot to minimize the problems with a big risk budget that he has versus my kind of much smaller one.
And when I look into the details, so recently I have tested Russell 1000, and trading Russell 1000 with very small risk, like 5 basis points, is producing way better CAGR. It is producing way better drawdowns and way better hit rate. So that's where we wanted to go. So that's where I wish I can go. My next step is to be able to trade as many markets as possible, not to pyramid up. Pyramiding up is very specific scheme. If you're able to trade only so many markets, then that there's you keep on saying that Paul Mulvaney is trading less than 60 markets. Yeah, then I get it. Yeah, but there's no reason to do that anymore. You don't trade 60. I want to trade 1,000 for Russell 1,000. Then I want to trade another 1,000 trade for European stocks, another 1,000 for Japanese stocks, because I'm able to actually get in touch with more outliers. And that 5 to 10% breaks down. My research shows that I'm able to get in touch with way more outliers if my trading universe is bigger. So I don't want to be, trading 60 markets. Oh God, no. And that's my take on it. Thanks a lot.
Yeah. I don't like that explanation that Jared just said, that because I've had profits with this previous trade, I am able to get on the next one, and I don't like it as well. I don't like it especially because it brings path dependency to the system, and that's something that usually we want to run away from. And we want to test things and evaluate things and compare things as closely as if they're independent. And when you bring path dependency, you cannot ever run you cannot ever eradicate path dependency from your life. Never. So on the back test, you wish to have as close as no path dependency as possible. And when you bring it as a system feature, that my profit on one trade will be as a cushion for the losses on the next one. When you bring this thing to your task, to your system, I don't like it at all. I think you're setting yourself up for disaster at some point.
I think the issue with pyramiding, and the way I understand it, is pyramiding being increasing your position size on a trade as it goes, the trend moves in your favor. And I think the problem with that is, to do that, you either have to increase your risk, meaning that as you add additional position to the trade, you leave your exit in the same place that it was originally, meaning that you are maintaining loose pants, which is increasing your potential risk. It's also increasing your potential profit, but you're increasing your potential risk. Or adding to the position and then tightening your exit to maintain the risk. And, one of those is potentially dangerous. You're increasing your risk. And the other is tightening your pants by tightening the stop or the exit. So I don't know how you do those two things while being honest to those ideas of either maintaining a loose pants on a profitable trade. And I would really like to hear how Moritz has approached this, and how Mulvaney does it, or how we think Mulvaney does it.
Ritz is being a bit cagey today.
So mysterious.
Hey, no, I don't want
He's
to.
probably still on that beach.
I don't. Yeah, I wish, Rich. I don't want to be mysterious, but I'm in between other calls. I'm sorry about this. I'm listening in. I wish I had a bit more time, but on the pyramiding, I really don't know how people do it. I'm thinking about it, and I don't have an answer, to be honest. There are so many different ways that you can possibly do this, but I think it needs to come with a health warning. It probably does have side effects, and this is not a free lunch. But yeah, I mean, philosophically, what I like about the idea, I mean, very generally, is that you are ahead. You have open trade equity. You have variation margin. It is P&L that's positive. You can click on the mouse and take it, but you don't. You don't realize it. It is other people's money. You've been right in the position. The markets have money, and you can, play with that money in the quote unquote casino more liberally than you could with your own closed core capital. So I like that, but I think you have that on the entry, like, how do you pyramid? When do you do it? With what size? There's many different possibilities to do that. I think Jerry at the very beginning mentioned, or maybe 10 or 15 minutes in, mentioned adding units, certain ATRs spaced apart. So, another 4 ATRs higher, another 4 ATRs higher, you take the third trade, another 4 ATRs higher, you take the fourth trade. Yeah, that's one possibility. You could combine that with, time, and say, if we're in a trade, in a winning trade for a longer period of time, then our statistics tell us that this ends up being a great trade because the biggest trades have the longest hold period. So, maybe we add to the position then, or you add to the position at a point where even when you add the second position, if both went to the stop, the first and the second position, your P&L would be zero. So you kind of like do this break-even trade. I really don't know. I've never done it. This is completely new to me. I'm very intrigued because of that Substack that George Coyle wrote, where he said that he read another book about Livermore by another author, and that he was wrong understanding Livermore's quote when he said the big money is in the waiting. And George and myself included, we always thought, well, that probably means like us. It's in the waiting with the loose pants, holding positions for a long time, not being short term, not trading in and out, just sitting there. And then he said, no, that's not true. What was meant is that the waiting for the perfect entry, like, be very patient and wait for the perfect entry. This is so difficult to do with our signals because, we just take them. They're perfect enough for us, but it's not like probably what these guys did when, everything needed to come together, like, technical trading signal, fundamentals, all these, 5 different parameters, everything needs to line up, and then they go big, and they add to it, like deep into the position or deep into the P&L, they would become larger. And it's like what Druckenmiller, I think, said a couple of times, what Michael Marcus has done. And so it seems to be, well, what's the sample size on this? I mean, Druckenmiller and Michael Marcus and Livermore, okay, so, one of them blew up a couple of times and is no longer alive. And we're looking at the traders that have done it successfully. So we've just mentioned 3. Maybe there's 3,000 that have blown up doing it that way. So I want to be it's to me, pyramiding is kind of like, playing with fire is so interesting when you are a kid, right? You want to light that match all the time, playing with fire. But now, I don't know. I'm no longer a big fire starter, so I want to be very careful with these things and spend more time on it and research it, and see what I can find if there is anything that makes sense. But to be honest, even though I like the idea, I'm more skeptical than anything else.
Yeah, the simple size is the core issue for me, because when we are implementing different systems, that one gets in on the 100-day count, the other on the 150, the other on 200, etc. I can treat them as independent stuff and look at the system statistics and have an idea of how it might behave. And then I can say that one system is more profitable than the other, and can compare stuff. I can have my decisions based on those statistics. Now with pyramiding, it's so much hard for me to get my hand on that, because I don't know if the second lever of the pyramid, the second step of the pyramid, is profitable or not. If 2 ATR is better than 4 ATR spacing, if it's time, as Moritz suggested, how can I compare that? Because the entry signals are dependent on a previous entry. So this path dependency, it makes any comparison much harder. And then if I cannot even have a lot of certainty or a good idea of how the first step works, what to say about the second step? How about the third step? I don't have a clue of how many steps how many steps would be good. If 5 steps is better than 6. Yeah, I have a lot of issues with this sample size thing, and that's why I got back from pyramiding, even though I at the time I couldn't trade much more than 20 or 30 markets. I think I do prefer to have different systems on. Than one system with a lot of different entries and exits and features, based solely on the sample size thing.
So basically, once you, first of all, you're gonna do the work and code this thing, right? So I've coded this. So the code is not trivial, okay? The code is not simple. It is not trivial. And everything else is testable, what Bruno said. So one of the interesting things I've noticed is, so your hit rate reduces something else like 25%, let's say, from 40%. But there is a trick which I've noticed later on. When I look into the ratio of all my trades independently, so if let's say that I have opened 100 trades initially and 100 scalings, 200 trades. From a 200 trades point of view, I'm still getting into the 40% rate. Okay, that's one thing that people usually don't see until you test it. But 25% is what you get on each trade. So, for instance, if you're counting your trades, the sugar, the cocoa, the apple, you get to 25%. But if you're counting the individual trades on it, I open 2 trades on Apple at the same time, including the one scalings, and you can scale in as multiple times as you want, so long as you code it and you test it like I do, okay, which is all possible. Just the code is not trivial. And then your hit rate is actually not 25%. Your hit rate is approaching to 40%, but you're gonna count it different. You're not going to count it like we do at the moment, because we say that, all right, there's one trade, so I'm just going to treat it like one bucket. So the cocoa is one trade, the sugar is one trade. But when you're doing the scalings you're gonna. So one way that I'm approaching this testing process is to be able to approach all trades different. So I have opened 200 trades instead of 100, and then I see it. It's just getting back to approaching to the 40%. I mean, as I said, it is a tool out there, but why you wanted to use it today is maybe it was a very smart idea in the past, but with the so many markets that are accessible to us today, I think in my tests the smart thing is to trade as many markets as possible.
You're absolutely right, Alp. Coding it yourself is it's the most important thing. It's the first step, actually, because you have to understand what you're doing and have your own assessment of how things are working. But I would say that the coding part is the first most fundamental step, but also it's not the hardest one. The hardest one is how do you treat and how do you interpret the conditional expectations and conditional probabilities. The path dependency thing is not trivial at all. It's not you cannot compare the expected return from the second step of your pyramid with the expected return of your first, because you have a survivalship bias there. You have a lot of biases there within your sample that are not easy to entangle. That's what I'm saying.
Yes, but don't forget, we don't do the same thing, brother. Yeah, because I trade thousands of trades with hourly bars, so I'm much more confident in the sample size. So you're trading daily bars with longer term systems. Your sample size is much lower, so it's a different ball game. But the idea is there, and it is the coding, as I mentioned, is not simple because it's an additional layer of complexity, to say the least. And then the way I'm doing is, I'm counting all trades and trying to look into it as, if I'm trading 100 markets, and if one entry is giving me 100 entries, and if additional scaling system is giving me 200 trades, I'm trying to look into that 200 trades. And in reality, I might end up with 10,000 trades, for instance, when I'm trading minute bars. Okay, so and when you do this sort of work with many years, with many market regimes, and so on, so it's all the principles that we talk about applies. It's just what I'm saying is I couldn't find a business rationale that actually could challenge the things that we are talking about here. So in my work, trading, hundreds and if not thousands of markets, it's just more smarter. It is better hit rate. It is less drawdown, and the CAGR is as good. Why do I need to restrict myself with 60? I really don't want to do that. I want to trade 1,000 markets. Thanks.
I love that. Yep, triple what my goal was. Yep, I like that a lot. Okay, so I want to get into a little bit of these two podcasts that I tweeted about with Eric and Meb, and the return stacking, and I want to summarize both of these podcasts into the parts that I tweeted about and that bother me. Yeah, it kind of bothers me, and yeah. So here goes. And what bothers me about this, of course, because I tweeted it, so you already know it bothers me, but it is that they are promoting these ideas and they've had success and performance has been good. That I'll create an ETF or a mutual fund that has a permanent allocation 100% of the time to stocks, long, like an index, an ETF, and maybe the return stackers are adding the bonds in there as well. And then I will trade a trend following account as well in that same fund or ETF. Currencies, commodities, stocks again, stock indexes again, and bonds. So, and Eric mentioned a kind of interesting thing, which is that in a bear market in stocks, like we had like last year, I guess. Well, we had something last year. Stocks went down. I don't know what a bear market is, but stocks go down. So he essentially is maintaining that long. 50% of the fund is long stock indexes, but he's trading trend following the stock futures, stock index futures. So he will kind of lose money on the longs and then offset that to some degree by shorting indexes, index futures. So you can see the problem there is one of these days we get another 2008. CTAs make a lot of money shorting stocks and shorting indexes. He probably will sort of break even on that because he's long half the fund in those stocks and then short the indexes. Okay, but that's not what I want to talk about. So here you have these two CTAs. Oh, wow. And then Eric, oh my God, he's the author, one of the authors, probably the author mostly of this paper from the 90s titled Trend Following Stocks. And it works, and stocks are wonderful to trend follow, individual stocks. Okay, so here you have two CTAs, two CTA funds, managed futures, they like to call themselves. And they are not going to mention the fact that, well, we're not going to trend follow those stocks. We're going to be permanently long. So then I come along and I'm like, oh no, I'm going to do half my portfolio in trend following stocks, but not stocks that are, hopefully, they're not correlated to these indexes. So like right now, I'm like long and short and not making nearly the amount of money in stocks and not making nearly the amount of money that just being long the S&P is, because once again, it's being driven by NVIDIA, and Microsoft and Apple and a few companies. And this is like doing really well. And some of the other, Japan doing really well. And there's no diversification there because CTA, managed future CTAs are long all of these indexes. There's no shorts basically left. And so here you have the CTA managed futures industry not willing to trend follow single equities to enhance the trend following experience. Okay, what do you think?
I think that I like the idea of Jerry, that trend following strategy will improve all the markets. All the markets we can see will be improved by this strategy. And even if we combine it, of course I don't do this, but if people combine trend following with something like buy and hold or buying deeps or so on and so forth, trend following will improve the system. So trend following is perfect. I always say this.
Well, I was laughing a bit after I gave that big speech because, I know that in order to have more impact, I need to be more calm and I need not to get so exercised. I was watching this guy. He's a politician here in the United States. He's one of the big politicians here in the United States. And he was talking to these reporters yesterday. And he was asking them these questions about basically trying to say, you're very biased against me and my party. And they are. But he lost his cool and he wasn't being very effective. And I was like, oh, don't talk like that. So I'm going to go on some of these podcasts in the future and I'm going to be talking about trend following stocks, classic trend following. And I know that I'm going to be much more, my ideas will be much more powerful if I can just maintain more of a calm attitude. And you can see I have a hard time doing that. Okay, are we trend following the stocks, or are you bothered by this as much as I am, that the very people who believe in trend following have submitted to this idea that let's just don't talk about trend following equities and making our portfolio of markets and trend following better, but let's just try to slide in there in the portfolio and we'll create the perfect portfolio of long equities, maybe even long bonds all the time with a tad bit of CTA trend following currencies, commodities, stocks, and bonds, and let's just try not to rock the boat, and let's just assume, that this equity risk premium is forever, and that it's probably the profits available in stocks are best captured by long only buy and hold, rather than our trend following.
It's like being a nutrition expert, but then promoting a diet that includes 50% unhealthy food, but even that doesn't taste as good as the healthy food. I mean, that's really what it is. If you're recommending somebody be 50% trend following and 50% S&P, you're saying, all right, here's 50% of what works and what's good and what tastes good. But then the other 50% is just going to be unhealthy food that doesn't even taste as good, but we're going to do it because that's what everybody else is doing. And from my perspective, I used to get upset about seeing things like this, but now I realize that it's an edge for the rest of us that know what the real truth is. Let them keep doing it, and we'll do what we know is right. And in the end, we'll probably end out better. And why try to be I can understand why you'd want to fight against that if you're in business. If you have a trend following plus nothing fund, I can understand why you'd want people to understand that. But for me, as an individual trader, I say let those people keep doing what they're doing. It just makes the edge for the rest of us better.
There are two things. There's the business of portfolio construction, which these guys are in, and then there's the business of absolute returns, which I think we're invested in. So when we talk about trend following, 100% plus nothing, we're in the business of these absolute returns. The portfolio constructors out there recognise that that's not a popular concept. And when you look at some of the best funds with the greatest absolute returns, like Paul Mulvaney, you see he's sitting on about 250 million AUM, compared to the portfolio constructors that are, dealing in, up to 10 billion in AUM. And this is where they change the style from that which they believe delivers absolute returns to accommodating the investors' passion for maintaining their perceptions that the equity bond portfolio is here to stay. So what they do is they say, I'm not going to fight this. What we're going to do is we're going to insert some managed futures into that portfolio to at least, make it a bit more robust. But as far as I'm thinking, is they're too accommodating to the investor demands. That therefore means that they will attract the AUM, but it's not necessarily in the interests long term of the investors of that principle. So, then you come down to the question of, management fees and performance fees. Do you pay management fees and performance fees to those that just appeal to investor appetites and, construct portfolios that are weak, diluted versions of something that can deliver absolute returns? Or do you pay the management fees and performance fees to those with true skill that have a passion for delivering absolute returns, recognizing that they are experts in the game and they know what is best for the investor in the long term, as opposed to subserving and treating the investors' demands as primary and their ability to improve their returns as secondary?
But excuse me, can I be a little devil's advocate here with two ideas that I think helps to make sense to that kind of product? Not that I'm against for them or against them, but the first one is the parallel thinking, meaning that when they stack stuff, it's like being humble in terms of timing and saying, okay, since I don't know timing, I will put everything together. And because these things works in the long term, it makes sense to have them on all the time. And the decorrelation, or whatever you want to call it, will take care of any issues that I have in between when they contradict each other. So instead of being serial and timing and changing allocations, maybe systematically or maybe discretionary, they do that. That's the first thing. And the second thing is the issue that many people raise, and you just talked about, Cherry's the equity risk premium. Because in the end, if making business is something sound, whether you're a person or whether you're a company, it's supposed that it will pay you something. So in the end, many people say as long as the world grows and as soon as economic activity keeps going, there will always be a reward for being a businessman and or having a company. So that will end up being what academically they call equity risk premium. So then the only issue is that you don't lose faith when things go very sour, which they do very much. Yesterday, I saw the longest running mutual fund in the US, and it had an 80% drawdown in 1930. But in the end, if you believe in world growth and businessman opportunities, etc., then you only have to, keep glued to the seat and nothing else. So it's not that I believe in this, but I think that could be those two very high arguments for that. One being, okay, I'm not timing, I'm having stacking. Stacking means it's something that it's not that it's at the same time. I don't guess what works or what's not. And the second is, okay, these premium exist, and if they exist, it's just a matter that you don't fall off the boat because of your lack of faith. Thanks.
Yeah, I guess part of my, obviously the main part of my problem with it is that the very people who seemingly believe in trend following, love trend following, they actually do trend following and can talk eloquently. Oh, the most eloquent talkers are the ones who don't talk about, dare mention trend following those same stocks. Now, they'll trend follow the equities, the stock index futures a bit. That part of the portfolio that makes the trend following strategy have better performance. I guess another thing that bothers me is, and you have the author of a paper who said trend following stocks works, and that paper has been replicated and redone, and it without any objections to that mere fact that obviously trend following single stocks works. And then I made the point that you put the CTAs in there, in that portfolio of traditional stocks and bonds because of crisis alpha, because you're going to have these crazy sell-offs. And so my point is trend follow the stocks as well, so you have fewer crisis periods. And we all know that eventually there's going to be some kind of disaster if you're investing and you don't have a trailing stop and a stop loss. We've seen it happen to very smart people who make a lot of money in hedge funds, simply with ridiculously large drawdowns. They don't lose their money. They don't lose the other half that they didn't lose necessarily, but it was all unnecessary. And then you get back to this whole idea that, and I'm on purpose not going to, look, if they have chosen not to talk about something, then I'm not going to talk about something. I'm not going to talk about this equity risk premium. I have no idea what this is. It's not part of my worldview. And I'm not saying that I'm absolutely not saying I know that it doesn't work or it's not valid. I just don't care, and I don't want to give it any thought process. Now, in the very end of life, I'll probably be proven correct that these people will lose all of their money or something. But we know from the research that done by multiple people, including Eric, when he was with, I think the company was Black Star at the time, that 4% roughly, this has been updated recently, like 4 or 5% of the stocks buy and hold make all of the money. And most of the stocks don't even return as much as the T-bill rate. So, and just think about a lifetime of a stock. You're basically saying, like, how many stocks over their entire lifetime make money? They're higher than when they started. And what a very difficult and hard hurdle. I mean, and then they say, okay, basically 4% do that. They make a lot of money. They just keep going up and up. And they have drawdowns, but they're not very big. And then now think about going through all the charts of all the stocks that ever existed and just scrolling through and seeing all of the trends that would pop up, longs and shorts, that your breakout channel would capture. And it could be, a handful of these trends that we would latch onto. And the whole idea that stock is not one of the 4% that made money and contributed to the performance of equities is totally meaningless to us, because we're in those trends and then we're out capturing those outliers, capturing those medium-sized trends along with the small losses. And so, okay, so you have trend followers promoting this idea that the equity risk premium is better than the trend following risk premium. Now, I expect to get pushback from value and growth and terms I have no idea what they fucking mean. I on purpose don't know what they mean. I want to get my brain cleansed of that sort of stuff. And I expect pushback from them. But the biggest pushback that I'm going to get, and in fact, it was one of the guys on Meb's podcast, basically came out and said, a trend following ETF with lots of markets is not a good idea. Okay, whatever. And so, but we're going to get the biggest pushback from the managed futures CTAs who love trend following. It's absurd.
But what it is, Jerry, it's a band-aid fix. Now, this return stacking concept is a concept we're all too familiar with in our diversified portfolios. This is a principle that we use in trend following to diversify our portfolios. We're using margin-based products. We have a lot of cash sitting there on the sidelines, and we're achieving this extensive diversification: equities, bonds, currencies, the whole gambit. But what this return stacking concept is, it's a band-aid fix for those investors out there that are reticent or reluctant to pull their allocations from equities and bonds from their buy and hold 60-40 portfolio. So what they do is they say, all right, we're going to accommodate your needs, recognizing that you know better than we do, because we're hardly experts in the field of delivering absolute returns. But what we'll do is we'll bring this concept called return stacking, where we'll turn 20% of your 40% portfolio of bonds into 20% of futures in bonds. So you still maintain your 60-40 exposure, but we're going to use the available cash from that 20% exposure in bond futures to a 20% allocation in managed futures. But, we're going to further put a band-aid on this, because you've already got 60% equity exposure. We're not going to suggest to you that you should be trend following equities, because you've already got 60% exposure in equities. So what we're going to do is we're going to give you a managed future allocation that excludes any further equities in that allocation, because you're already highly exposed to equities. But what it's doing is it's giving them a band-aid fix, trying to make their portfolios more diversified and more robust. But it's a far, from, what the 100% trend following portfolio does, which is a much more efficient way to distribute your money using margin-based products, geographic diversified exposure. And really, it's just succumbing to investor appetites. That's all it's doing. It's not giving them an optimal solution.
That's right. And what I wanted to do, what I want to do is say, or would expect them to say, is your allocation to equities is suboptimal. Sell those long only. And if not coming from me or people in the CTA world, who's it going to come from? and it's not going to come from the CTA world, but sell those equities and invest those equities, the money from those equities, into a fund that's trend following equities. And this is not going to be advocate. In some of these podcasts, they go on talking about the benefits, lower drawdown, shorts, skew, and all of the benefits of trend following, and then silent when it comes to the portion of a person's portfolio that is the most important to them, those stupid stocks. And so you would think that the one group of people who would be advocating for this, honestly, come on. But it's like, no, we cannot talk about it. We live in a place where it's not cool and politically correct to talk about what we do, applying that to what you have the most of. And it's absolutely ridiculous. It's a combination of CTA behavior and the facts as we know them, that they will have better performance from their stocks if they trend follow those stocks. But it's a complete sellout to the captors, the people who create these portfolios. And I'm not saying you don't have this product. I'm just saying advocate. When the client comes in and the nutritionist hears them say, 50% of what I eat is all sugar. And they're like saying, I've got to make a living. If I try to advocate to these people, no sugar, only broccoli, then I'm not going to have any clients. I understand, but you owe it to these people to say, you probably shouldn't have half sugar. Instead of saying, I'm silent on that whole issue, but let's add in 50% broccoli.
So this part of conversation is difficult because this time we are going against the trend here, and when we go against the trend, it's always difficult, right? So the equity investments mainly, in London, I come across with many people, and some of my friends trade equities, and they usually would like to use investment banks, in London, like the Royal Bank of Scotland and whatnot, and in US possibly JP Morgan's and whatnot. So this is the news, the power, the reach, the marketing, the sales, the Bloomberg, the CNBC is all there. So I'm not quite sure what is the right strategy, rather than just waiting it out and doing my own bits, and everyone else does their own bits in the trend following space, and then perhaps one day we become majority. But at the moment, trading equities with trend following space, I say it is a contrarian opinion. Thank you.
Well, I think that we should be go against the trend of people who are going against the trend. So I think if I should go against the trend of people who mean revert, and these. So I think it's fine. I don't think we're going against a good trend, so I'm all in favor of calling these people out. And it's a battle, and it really is another controversial thing that happened this week too, which is pretty funny actually. The last, I think it was the most recent. Well, no, it's not the most recent Top Traders Unplugged, but I guess it's the one after Andrew and Tim duked it all out. And that is that Andrew Niels had on Nick Baltus, I think, and I like listening to Nick. He's a good guy, and I have to tell you, I love these TTU podcasts. Even though part of the reason I like them is because I disagree with them so often. Unless Richard's on there, I pretty much have a lot to kind of laugh about, or just like get ready to tweet something a little bit nasty or negative. So anyways, I thought it was pretty interesting that I think one of my takeaways, I don't know if I mentioned this, from Andrew and Tim is that you're going to get some massive pushback from people. I tried to find the quote. There's a quote out there, so send me this quote. It has something to do with people defending their positions based upon the job they have. So they'll defend their position if it means money to them. I couldn't find this quote, but I think a lot of what came across to me, and I love Tim, and I think he's talented and great, but obviously what came across was he's very pissed that this could cost him money. And this replication is no fun, because if this guy's too successful, then people will go to Andrew versus managed feature CTAs. And Absolute had some good tweets this week about replication and pushing back on things that I had said and tweeted. And I'm sad he's not here with us today, so we'll have to remember that for next week. But so anyways, I think that Niels likes to hammer on a bit on the replicators too. And some of the issues that people have with the replicators, I agree with. And I think that Tim had some good points and Niels has some good points about the problem with replication and DBMF in particular, of course. And just as an aside, this fund that the return stackers talked about on Meb Faber, they are too replicating the CTA piece. They're going to replicate the positions and replicate systems. And that is very interesting and unique. Okay, so anyways, to get to the controversial part, Nick Baltus and Niels were talking about ETFs. And so I'm coming out with this ETF. I can't really talk too much about it, but one of these days we'll have an ETF and we will trade the 300 markets and 150 stocks portfolio. So basically, Niels is really uptight about ETFs as well. And, this an active ETF that charges 95 or 100 basis points is no more a friend of his than this replicator. And I think a lot of it does revolve around the low fees, and which is what things are in ETF world. So basically, Niels said, I think that people who have ETFs are just people who are not good traders. They're not good money managers, because if they were good, they would. And so, as Andrew is fond of saying, fee reduction is the purest form of alpha, which he got hammered for a bit. And Niels' response was, I think that low fees are a negative alpha. It's signaling that you don't know what you're doing, really. So anyways, so then I guess I'll have a chat with him about that next month. But that's going to be pretty interesting to talk about. So he is ready. He's ready for this ETF and our conversation.
I'm going to be listening with all ears, Jerry, on that one.
I've got a lot of notes and things I want to talk about, and but once again, I got to maintain my cool. And I was looking at an old email yesterday with, I think it was Niels, me, Richard, and maybe even Moritz, but I'm not really sure. And it was Niels. We had sort of said something. I think it had something to do with Mulvaney, and Mulvaney was making money. This was an old email, and I think Niels was like, "Yeah, that's really amazing how great he is." And I'm kind of like, I have to admit that he is really good, and his classic way is really good. And he said, but I'm like, I feel good that I'm here to moderate between Richard and Jerry versus Rob and somebody else, So he was our moderator, but now I think he's joined the other side officially. He said, one of the funny things he said in the podcast was that it's going to be a very hot summer here on Top Traders Unplugged. That was pretty funny. I like that. I tweeted it. I thought it was amazing. One thing about life is that I really think that with things that are funny and comedy kind of usually should trump any kind of serious discussion of trading or politics. So you leap to the top of the class with an A plus if you can interject some sort of humor into all of this, because we're all in a good situation because we know about trend following and we know about the right rules. And like Alp was saying, we apply a little bit differently to suit our personalities, but so much more important to enjoy life and enjoy that with some humor. All right, unless anybody has something else, who wants to wrap it up so I can go on to my next meeting? Anybody want to say anything? Any comments, questions? All right, just short of 2 hours, and we will see you guys next week, 8 a.m. in our little clubhouse. My wife is making fun of the clubhouse. Well, I call it clubhouse to her because I'm like, she's waking up, I'm getting her coffee, and I have to break it to her. This is Friday, and I have my little clubhouse. And she goes, "Oh, you guys are so crazy and silly with your clubhouse." And she goes, "Do you let girls into this clubhouse?" And I'm like, "Oh, we used to have women show up and to our little clubhouse, but we need to get women back here. And we don't really have any women trend followers or semi-trend followers in our little group here, and we really need to do that." And I even admitted to her, all of us guys, I think we sit there for 2 hours talking about trend following, and we never even think about women at all for these 2 hours. And then we're these little nerds, and then we're like, oh, back to the real world. So what we need to do is find some female trend followers and get them on here so they can add some diversity and some more intelligence to our conversations. All right, guys, have a good weekend. See you next week.